Welcome to the deep dive. Today, we're getting into something that, well, it affects all of us. Money. We all deal with it, maybe stress about it sometimes. And let's be honest, we often don't fully grasp what drives our choices. What if I told you that doing well with money has less to do with how smart you are and maybe a lot more to do with just how you behave? That's really the core question for our deep dive today.
Yeah.
We're digging into the surprising psychology behind our financial decisions. We're leaning heavily on Morgan Housel's book, The Psychology of Money. Our mission, uncover why we make the choices we do. Some of these patterns, they're pretty counterintuitive, but really impactful.
Yeah, it's interesting because finance is usually taught like it's all math, right? Just formulas and data. But that view totally misses the human side of things. So this deep dive, we're framing financial success as more about these soft skills. It's this mix of emotions, our past experiences. And these skills are often, overlooked, but they might just be the most crucial tools you have for managing your money well.
Okay, so let's start with an idea that feels, I don't know, kind of freeing. The book says no one's crazy. Now, that sounds simple, but think about it. We often look at someone else's money decision and think, that's completely irrational.
Exactly. But Housel's point is that their crazy decision probably makes perfect sense from their point of view, given their life.
So accepting that, what does it really change for us, beyond just being more understanding?
Well, it's fundamental, really, because how we see money, our whole financial worldview, it's shaped by such unique stuff. I mean, the economy you grew up in, what your parents earned, your values, even just plain luck. It all feeds in. You can study economics forever, but nothing really replaces the power of what you've actually lived through, your personal experience. That's often way more convincing than any textbook lesson. It dictates your priorities.
There's this example in the book, the lottery tickets one. It really hits this point hard. Americans spend, get this, more on lottery tickets than on movies, games, music, sports, and books combined.
Wow, that's a lot.
Yeah. And it's mostly lower-income households buying them, like $412 a year on average. That's 4 times what higher-income groups spend. Now, pair that with the fact that, 40% of Americans couldn't cover a $400 emergency.
Right. So from one perspective, it looks totally irrational. Why spend money on lottery tickets if you don't have emergency savings?
Exactly. Seems crazy. But Housel argues, for someone in that situation, it's not just a bad bet. It's buying a, quote, tangible dream.
Okay. A bit of hope, however small the odds.
Yeah, hope for a totally different life. Something others might just take for granted. From their perspective, it makes sense.
And, zooming out a bit, a lot of the financial stuff we deal with now is pretty new, historically speaking. Things like planning for retirement, 401ks, saving for college, even widespread credit card debt. These aren't ancient concepts.
That's a good point. Like the 401k, when did that even start?
1978, I think, and Roth IRAs, even later, like 1998. So for many of these really important decisions, we're all kind of newbies. We're figuring it out without generations of experience to fall back on.
Right. So maybe we shouldn't be so quick to judge ourselves or others when we mess up or make choices that don't look optimal on paper.
Exactly. We're all learning as we go.
Okay, so our individual experiences matter hugely, but then there's this other layer. How much is actually in our control? We love to think success is all hard work, right? Meritocracy. But this deep dive suggests there are these big, maybe uncomfortable forces, luck and risk.
Oh, absolutely. It's a tough one to swallow sometimes, but crucial. The book tells that incredible story about Bill Gates and his school friend, Kent Evans.
Right, the Lakeside School computer.
Yeah. Gates had this 1 in a million luck, right, attending one of the very few high schools in the world with a computer back in 1968, funded by a rummage sale.
Crazy luck. A huge head start for Microsoft.
But then his friend, Kent Evans, equally smart, equally ambitious, he experienced the flip side. 1 in a million risk.
The mountaineering accident.
Yeah. Died before graduation. Same magnitude of force, luck, and risk, but in totally opposite directions. You see, they're siblings, luck and risk. You can't really believe in one without respecting the power of the other.
Why do they happen, though? Is it just randomness?
Well, the world's just too complex, isn't it? Too many moving parts for our actions alone to determine 100% of the outcomes. Stuff happens.
So what does that mean for us? Like when we look at billionaires or huge failures, should we even be studying them?
That's the danger the book points out. Focusing only on the extreme outliers, the Vanderbilts or Rockefellers or the spectacular flameouts, their stories are often the least applicable to us because extreme luck or extreme risk played such a massive role.
You mean like Vanderbilt bending laws for his railroads, Or Rockefeller finding ways around them.
Exactly. We might call them visionaries now, but with slightly different luck, maybe they'd just be seen as criminals. It's a thin line.
So don't just study the outliers. Look for broader patterns.
That's the idea. Look for patterns that apply more generally. And for you, the listener, respecting luck and risk means realizing that when you look at someone's financial situation, yours or someone else's, nothing is as good or as bad as it seems. It helps bring some humility when things go well and maybe some compassion when they don't.
Yeah, take some pressure off, maybe.
Yeah.
Acknowledging factors beyond just effort.
Definitely.
Okay, we've talked perspectives, luck, risk. But let's say you achieve some success, you start building wealth. There's another trap, isn't there? This insatiable appetite for more, never feeling like you have enough.
Oh, that's a big one, the enough problem.
The book mentions that Joseph Heller anecdote, the author of Catch-22.
Right, at the party with the hedge fund manager.
Yeah, someone points out the manager made more in a day than Heller made from his massively famous book, ever.
And Heller's reply was just perfect.
Yes, but I have something he will never have.
Enough.
Chilling, almost. That word, enough.
It really is. And think about those stories. Rajat Gupta, McKinsey CEO, worth $100 million.
Risked it all for insider trading. Why? Yeah. To get into the billionaire club.
Or Bernie Madoff, already incredibly successful, legitimately, then runs the biggest Ponzi scheme ever.
They had everything. Money, status.
But they wanted more. It's like Warren Buffett said, risking something important for something unimportant. It just doesn't make sense. It's foolish.
So where does this come from? This need for more?
Well, the book argues one of the hardest financial skills is just getting the goalposts to stop moving.
The comparison trap.
Exactly. Social comparison is a battle you just can't win. Mike Trout makes $36 million a year playing baseball. Seems like enough, right?
You'd think.
But he could compare himself to a top hedge fund manager making $340 million, who then looks at Jeff Bezos adding, $24 billion in a single year?
The ceiling is just impossibly high.
Right. So the only way to win that game is to refuse to play it.
Okay, so for people listening, given these crazy examples, what's like one practical thing they can do today to define their own enough and shield it from that comparison treadmill? Something maybe counterintuitive.
That's a good challenge. I think counterintuitively, it might be about consciously defining enough for right now, not some future goal, but today. And maybe even saying it out loud or writing it down. Then actively focusing on what you already have that's more valuable than money.
Like health, relationships, freedom.
Precisely. Gratitude, really. Shifting focus from just accumulating more stuff to appreciating what's already there.
It's not about aiming low then.
Not at all. It's about realizing that chasing more endlessly can lead to huge regret. You risk the things that actually matter: reputation, freedom, family, happiness. Defining and respecting your enough is maybe the strongest financial move you can make.
That's powerful. Okay, let's shift gears slightly to something that sounds simple, but is maybe the bedrock of wealth building: time and survival.
Yeah, the silent superpowers, as you called them. Often overlooked.
We all study Warren Buffett's stock picks, right? His genius.
But his real secret weapon, it's time. He started investing as a kid and just kept going for like 75 years.
So even though someone like Jim Simons got much higher annual returns.
Right, Simon's got like 66% year, Buffett only 22%. Phenomenal returns for Simons.
The Buffett's way richer.
About 75% richer, yeah. Simply because he let compounding work its magic for decades longer. Longevity was his edge.
Compounding is weird though, isn't it? Our brains don't naturally grasp that exponential growth.
Not really. We think linearly, like step by step. Exponential growth feels counterintuitive. Housel jokes the best finance book title would just be, "Shut up and wait."
I like that. Okay, so time is key. But you also need to survive long enough for time to work. Right?
So that's the other side of the coin. Getting wealthy and staying wealthy are two different skills.
You mentioned Jesse Livermore, the trader who made billions in 1929.
Yeah, made a fortune, equivalent to $3 billion today, then lost it all. Overconfidence, kept taking huge risks, ended tragically.
Compared to, who was it? Abraham Jermansky?
Another multimillionaire wiped out in the same crash. So getting rich might involve optimism, taking risks, but staying rich, that takes humility, frugality, even what Housel calls paranoia.
Paranoia, like expecting things to go wrong.
Sort of. An acceptance that the gains you made can disappear just as quickly. not getting complacent.
This sounds like that margin of safety idea from Benjamin Graham.
Exactly. Room for error. It's not just being defensive, it's building buffers, like having enough cash so you can withstand the inevitable downturns, so you don't get forced out of the game at the worst possible moment. You need to endure to let compounding do its thing.
Like that example of Sue, the investor who just kept putting money in every month through thick and thin.
Yeah, from 1900 to 2019, she weathered every crash, every recession, just kept investing, ended up way ahead of Jim and Tom, who tried to time the market, jumping in and out.
So it's about being financially unbreakable.
That's a good way to put it. Letting good returns compound for as long as possible. And crucially, forgiving yourself when things go wrong. Because they will. It's part of it.
Okay, forgiveness, survival. Let's connect this more directly to, well, happiness, freedom, maybe, and this idea of hidden wealth.
Yes, because what's the point of money if not to improve our lives?
The book puts it beautifully. The highest form of wealth is the ability to wake up every morning and say, I can do whatever I want today.
That's it, isn't it? Control over your time. That's the ultimate prize money can buy, I think. Independence.
It's not just about having a huge bank balance.
Not necessarily. The author talks about wanting that investment banking job for the big salary.
But realizing it meant zero control over his life. Misery.
Right. Contrast that with Derek Sivers, the entrepreneur who saved just $12,000 back when he was 22, quit his job, became a full-time musician. He says the real freedom came then when he bought back his time, not years later when he sold his company for millions.
So money buys options, buys time, which leads to that other idea. Wealth is what you don't see.
Ah, yes, the difference between being rich and being wealthy.
We see the fancy car, the big house, and think, wow, they're rich.
But that's just spending. Often, that's richness, which is visible income being used up.
Like the story of Roger the valet parking attendant whose Porsche got repossessed.
Exactly. The expensive car didn't mean he was wealthy. It meant she had $100,000 less cash or $100,000 more debt.
So wealth is income not spent.
That's the core of it. Wealth is the unspent assets, the stuff working for you behind the scenes. It gives you options, flexibility.
Like the diet analogy in the book. Wealth is the net calories not consumed.
Yeah, it requires self-control. And this highlights why your savings rate is just so incredibly important. Building wealth often has less to do with your income level or your investment returns.
And more to do with simply how much you save.
A lot more. It's like energy efficiency. The U.S. uses way less energy per dollar of GDP now than in 1950. We didn't just find vastly more energy. We got much better at not wasting what we had. Saving is financial efficiency.
So for you listening, the takeaway is focus on your savings rate.
It's probably the factor you have the most control over. A high savings rate creates that gap, that buffer. It's your hedge against surprises. It buys you that flexibility, that control over your time we talked about.
And sometimes it's less about earning more and more about checking your ego, lowering expectations.
Raising your humility, maybe? Building that cushion.
Okay, but let's be real. It's complicated. We aren't robots making perfectly rational calculations.
Not at all. We're emotional creatures. Which is why, as the book says, reasonable is greater than rational.
Meaning what works on a spreadsheet might not work in real life.
Pretty much. Because real life involves feelings, regret, sleeping at night.
Like Harry Markowitz, the Nobel Prize winner for portfolio theory, the guy who invented optimal asset allocation.
Yeah, even he didn't follow his own complex models perfectly for his own money.
He just split it 50-50 stocks and bonds.
Right. Not because it was mathematically optimal, but because it helped him minimize future regret. He wanted psychological comfort. Rationality takes a back seat to being reasonable sometimes.
And then there's the fact that we change. Our goals aren't fixed.
Oh, definitely. The end of history illusion. We always think our current self is the final version.
But our future self might want totally different things.
Happens all the time. Makes planning for 30 years out really tricky.
So how do you deal with that uncertainty?
Kahneman's idea of ignoring sunk costs is key here. Don't let a decision you made at 18 trap your 40-year-old self.
Like sticking with a career you hate just because you spent years training for it.
Exactly. Be willing to adapt. Aim for balance, now moderate savings, but also free time, family time. That helps you endure changes over the long haul. Flexibility is crucial.
And this ties into knowing what game you're playing, right?
Right.
Not getting caught up in other people's games.
Absolutely vital. Bubbles often happen, like the dot-com boom or the housing crisis, when long-term investors start taking cues from short-term traders.
They're playing different games entirely.
Right. A crazy high price for Yahoo stock might have made sense for a day trader riding momentum.
But it was disaster for a long-term investor looking at fundamentals.
You have to know your own time horizon, your own goals, and stick to them. Don't get swept up.
It's so easy to do there. We see others making money quickly.
FOMO is powerful, fear of missing out, but it can lead you way off course.
Speaking of psychology, why does pessimism always seem to sound smarter, especially about money?
Huh. Yeah, it does, doesn't it? Bad news just seems more credible somehow.
Why is that?
Well, part of it's probably evolutionary loss aversion. Threats feel more urgent than opportunities. Our brains are wired that way. And also, money affects everyone. So bad financial news grabs universal attention. Good news is often slow, gradual.
Like the huge drop in heart disease deaths over decades? That doesn't make headlines every day.
Exactly. Progress is often invisible, happens bit by bit. Setbacks are sudden, loud, and demand attention. Building takes time. Destroying can be quick.
So understanding that bias is important for us.
Yeah, it helps you contextualize the constant stream of negative news. It lets you make decisions aligned with your long-term plan, recognizing that optimism, statistically, has been the better bet over time, despite those scary moments.
Wow, okay. This has been, well, a really deep dive. We've gone from no one's crazy to luck, risk enough, time, survival, freedom.
It all comes back to managing ourselves, doesn't it? Our emotions, biases, behaviors.
Less about complex math, more about understanding human nature, including our own.
Precisely. And Morgan Housel, the author, he shares his own approach at the end, his confessions. They really underline this.
What does he do? Is it super complex?
Not at all, actually. He values independence over being rich, lives below his means.
Okay, that makes sense.
He owns his home outright, pays off the mortgage, even though, on paper, maybe investing that money would yield higher returns.
He does it for peace of mind.
Exactly. The psychological benefit outweighs the potential financial optimization, and he holds more cash than most advisors would probably recommend.
Why cash? Isn't that losing to inflation?
He calls cash the oxygen of independence. It means he never has to sell his stocks during a downturn just to cover expenses or because life happens. It gives him flexibility and control.
So his choices aren't purely rational by spreadsheet standards.
No, but they're reasonable for him. They let him sleep at night and stay invested for the long haul. And his main point is just that. Find what works for you. There's no single right answer.
That feels like the perfect place to leave it. A great final thought. So, for everyone listening, maybe take a moment after this. Think about your own psychology of money, what drives your decisions, and maybe, just maybe, what's one small shift in behavior inspired by these ideas that could nudge you closer to your version of financial freedom and happiness.
It's an ongoing process, for sure.
Absolutely. We're all just figuring it out. Thanks for joining us on The Deep Dive.